If you are a dividend growth investor that is interested in paying your bills with cash flow from dividend stocks, I have a framework today that I want to share with you. This is a framework that I personally use, and it helps me segment my stock portfolio. It helps me understand which specific stocks to place in my portfolio based on my financial goals, based on my goals for passive income at a specific point in time in the future. I have found this framework incredibly helpful. I think you will as well, as you're out there planning your own dividend stock purchases, and I'm really excited to share this with all of you today. So let's get started with another exciting video about dividend stock investing. So I just did a video, I will link in the description below. This video answered subscriber questions. And one of these questions I already addressed in the last video, but I want to go into even more detail today because I was thinking about it. And this is a subscriber who asked me this question on Twitter. Thank you so much. I love it when questions come through not only on YouTube, but other platforms too, like Twitter. And this question was basically, why would anyone buy Disney stock right now as a dividend investor, someone that wants to live off of cash flow? Because the starting yield, it's really low. It's 1.3%. And so I'm going to expand upon that a bit today, but I'm going to do this in a little bit of a different way. I'm not only going to talk about Disney stock, but I'm going to show some math behind three separate stocks, which I actually own all three. Well, Disney, my kids own, but I own the other two in my personal stock portfolio. And so I'm going to talk about Disney stock, 3M stock, and Duke stock in today's video. And before I even get into this, I want to give you some context behind this. What's going on in my personal life right now? Well, I'll tell you, I've been building a dividend stock portfolio for a long time, and my personal dividend stock portfolio, it kind of skews towards the longer term. I tend to invest in stocks that have a little bit of a lower dividend yield right now, but they're growing the dividend yield really quickly. I do that, but I also mix in some high current yielders as well. And the reason I do this is my time frame for using my dividend stocks to pay my bills. It's not yet. It's a little bit further. But I'll tell you, here's what's going on right now. We just got back from Hawaii. I'll link in the description below to a video I did about that. And we go to Hawaii once or two times a year, and it's very expensive, by the way. But we love spending the money for this because it is so memorable. And I get home, I get plugged back into my routine, and I live in the SF Bay Area. We love it here, but I get home and it's kind of raining, and it's, you get back, reality hits in, and we're like, hey, this is not as fun as it was when we were in Hawaii. And I start thinking like, hey, each year, what's one of our big expenses? What's one of our big family expenses? It's actually going to Hawaii, because sometimes we go multiple times a year, and we have two kids. It's expensive just to pay for the airfare. And I'll tell you, when we stay there as a family, it's important for us to be in a villa type accommodation. What this means is it's typically something that has a little bit more space. Either a 1 or 2 bedroom villa is what's ideal for our family, because it has the washer dryer, it has a kitchen with all the appliances, it has separate bedrooms for everyone. Everyone can live there very comfortably. We all get our sleep, because the last thing I want to do is go to Hawaii, be crammed into a really small hotel room, no one gets any sleep, no one has any fun, and then what's the point of the vacation? Anyways, when you go out and you want to enjoy a villa accommodation, it is very expensive, especially when you want to do that oceanfront on Maui's Kaanapali shores, for example, at Kaanapali Beach. And so anyways, I get thinking, hey, what's one of our big family expenses? What do I want in my life right now? I started thinking, I'm like, look, I want to go to Hawaii more. I want to be able to do this more. And how can I responsibly do that more? Well, what I basically decided is, hey, I got this universe of dividend stocks that I own right now. I own 40 of them. I cannot, in good conscience, start pulling cash flow out of that stream to pay for us to go to Hawaii more than we already are. And I just don't feel like it's time. It's not time yet to tap into that dividend stream. I just don't feel like the time has come, because that dividend portfolio, it's really built for paying everyday living expenses, for covering everyday living expenses. And until we use it for that, I want to reinvest the dividends. I want to grow the snowball. And so anyways, I start thinking, you know what, Ian? I'm going to go out and create a completely separate portfolio. I'm going to segment a separate portfolio here. I'm going to create a new portfolio. Probably I'll start doing this in the next few months. Right now I'm just saving up my cash so that when I start the portfolio, it's got a nice little lump sum to get going. I don't want to start with just some small amount. I want to kind of have something meaningful there to start. So you'll see in the next few months, I'll share here on YouTube what I'm doing. But basically, I want to create a new portfolio, and you know what I'm going to do with that portfolio? I'm going to start pulling the cash out of it that's generated from my dividend stocks that are in that portfolio. I'm going to use it immediately, day one. I'm going to use it now to get us to enjoy more vacation time in Hawaii. And in the early years, that dividend portfolio will not cover the full vacation, but my hope is after about 3 to 5 years of investing time, that portfolio will generate enough income for us to fully pay for a 1 or maybe even 2 vacations in Hawaii per year. And these are expensive vacations. I'm talking about probably $10,000 a pop to do it. And so this is some good dividend income to make this happen. And, you know, I want to pause here, actually. I'm going to link in the description below. A lot of people, they're going to say, Ian, why would you want to spend that much on a vacation? I'm going to tell you, I am not in the camp of living a really lean FIRE, financial independence, retire early. I am about as fat of a FIRE as there is. There's different types of FIRE out there. I'm in the school of thought that I want to be FIRE. I want to be financial independence, retire early. I want to do this through dividends. But look, I am not a lean FIRE. We're not going to cut on expenses too much. We want to enjoy some luxuries in life, and one of those luxuries is going on a first-class experience as a family to Hawaii. Anyways, it's expensive. In good conscience, I cannot tap into my existing portfolio to make that happen, because that existing portfolio, that is for everyday living expenses. That is for sustaining us. And this is obviously a luxury type of expense. And so anyways, there's kind of 2 things I want to highlight here. One, this whole notion of segmenting a special portfolio to pay for something that is a luxury or a passion. I just never had this idea before, and I'm excited that I did have this idea now, because it's really gotten me even more excited about investing, because I'm like, look, Ian, you get this portfolio going. This is going to change your life now. You don't have to wait for your retirement to tap into that and enjoy it. It's going to help now, because you're going to use the dividends. You're already creating a charter. You're creating an operating statement before even launching this portfolio that all dividends generated are going to pay for expenses for family vacation. So that's kind of thought 1. But insight 2 here is this is a different type of portfolio. My other portfolio, the one that's meant to sustain our living expenses, that's a little longer term. And so I need a little more dividend growth in there. I need a little bit more lower yielding stocks in the short run in favor of more yield in the long run. And so that's what I got now. But you know what? The new portfolio, I'm just going for the high yielders because I want the money now. And so I'm going to go after the high yielding stocks. And so the reason I'm giving this background is it directly applies to that subscriber question that was asked. I am so blessed for the amazing community here. And so thank you for that subscriber question. And it totally talks into this framework. So anyways, now that I've given you the background, I want to share a tale of 3 dividend stocks and how, as an investor like myself, look, I'm going to calibrate a new portfolio here. I'm going to do it to pay for vacations. How am I going to do that? I'm going to look at the data. And so as you're at home, you're thinking, what's your portfolio for? Is it for short-term expenses right now, like my new vacation portfolio is going to be? Is it for medium-term expenses, or is it for the real long-term? I'll tell you, I have mentioned before, both of my kids own Disney stock. They're not going to be tapping into that dividend income, hopefully, for a very long time. Many decades. I'm talking 30 to 50 years. And so there's a very different calculation. There's a very different thought process that goes into constructing that kind of portfolio versus my vacation portfolio. And you're going to see this as the data unfolds. You'll see it through these 3 stocks. So basically, I want to talk about the compound annual growth rate. So CAGR. There's this formula I'll share it with you right here. If you take the new dividend and you divide it by the old dividend, it could be any comparison. I do 5 years, so I look at basically the current dividend versus 5 years ago. But you could do 10 years, you could do any period. I look at the new dividend divided by the old, and then you raise it to the power of 1 divided by the number of years that have elapsed. For me, it's 5 years. Once you do all that math, you subtract the number 1. At that point, the formula will tell you, on average, how much has the company raised its dividend per year. You can find this stuff online too. Just Google it, compound annual growth rate, CAGR. Google it, you'll find this formula as well. Anyways, the CAGR for Disney stock is 15%. That's over the last 5 years. For 3M, it's 11%. And Duke, 3.5%. So right off the bat, you can see here, these are 3 different types of stocks. The first one, Disney, it's really quick at growing its dividend. The second one, 3M, it's also really quick at growing its dividend, but not quite as much as Disney. And Duke, it's kind of slow at growing its dividend, but not bad for a regulated utility. Now, I'll tell you, Duke, I think they can continue that 3.5 in perpetuity. Disney and 3M, you might see it a little bit lower. As more time elapses, those percentages will go down. Maybe the 15 becomes a 12, maybe this 11 becomes an 7 or an 8. That being said, I'm using this just for a point of comparison because it helps me select which stocks to place in my portfolio. So anyways, I do this whole table. I want to walk you through this. Year 1, well, first I do a comparison based on time. So you'll see in this column here, year 1, then 5 years out, 10 years out, 20 years out, 30 years out. So I'm modeling different time periods. And the reason I'm doing this is I'm asking myself, look, do I need the dividend income now in year 1? Do I need it 10 years out, or do I need it 30 years out? You can model this even further. But it's important at home just to ask yourself that question. When do you need your dividend income? My new portfolio, I need it now. My existing portfolio, you're looking probably 10 or so years out when really we'll start tapping into it. That being said, I always reserve the right. I always reserve myself and my family the right that if we need to start tapping into it now to pay certain living expenses, we have that luxury. And so anyways, then I have all the different stocks. I have Disney, I have 3M, and I have Duke. I have 2 columns for each of these stocks. I have the dividend, and then I have the yield on cost. So what is yield on cost? I'm going to do a quick summary of this. One of my first videos on here on YouTube was about yield on cost, so I think by now everyone knows, and I'll link in the description below to that video. But anyways, what yield on cost is as a dividend investor, you're basically looking, how much money can I yield on my money invested, on my cost? It doesn't matter where the stock goes. Stock could go up, stock could go down. In general, I like to see stocks go up over time because that's a sign of a well-managed company. But stocks could go up, stocks could go down. Anyways, that doesn't matter to me. I never plan to sell. What I plan to do is take my yield, my dividends, and pay for stuff with them. And so what's really a metric that matters to me is yield on cost, which is literally as a percentage of the money I'm investing, what am I getting back in terms of dividends? And that yield on cost, it changes over time. The reason it changes as the years progress because of this, because the companies grow their dividends. And so I have the dividend and then the yield on cost. And the way I calculate yield on cost is I just take the dividend and I divide by my purchase price. And so Disney, current purchase price per share as of today is $132.62. 3M is 163.35, and Duke is 87.12. So literally I take whatever the dividend is on any given year and I divide by the current share price, which would be the purchase cost. Now, how do I come up with the dividend? How does this dividend change over time? Well, the dividend, the starting dividend, is literally what it is now in 2019. That's the dividend. What is it 5 years out? Well, I just take the current dividend and then I multiply by, let's take the case of Disney, 15% increase. I take the current dividend, I multiply by 1.15, and then I take it to the power of how many years have elapsed. So here, 5 years have elapsed. So literally, I get the 3.54 by taking 1.76, multiplying that by 1.15 and raising it to the power of 5. And so I could do this for 10 years out. The only thing that changes is now I raise it to the power of 10. 20 I raise it to the power 20, so on and so forth. You can see over time the dividend. This is just the raw dividend in dollar terms. It grows. It grows over time because there's a growth rate. I'm making the assumption that there's this compound annual growth rate will continue. Like I said, it might be a little lower over time, but this is just to illustrate a comparison so that I can choose which stocks do I want in my new portfolio, the high yielder, or hypothetically, let's say I wanted to create yet another portfolio for the real long term. Which stocks do I want there? It helps me make a comparison. And so anyways, these assumptions, the numbers could be a little different, but still the relativeness of them, the comparison of them will still hold up. Anyways, the Disney dividend grows over time. It grows considerably. And you can see this yield on cost, it takes a while, but it gets really big. And so the fact of the matter here is what Disney is it's a tale of a stock of going, right now I want to retire tomorrow or I want to pay for my vacations tomorrow on Disney dividends. Not going to happen at a 1.3% yield. It's not enough. And so if I need it in 5 years, I'm only going to get a 2.7% yield. Not enough. 10 years, 5.4% yield. It's okay, but it's still not as good as I would want in 10 years. Here's the magic though. If I don't need to touch my Disney stock for 30 years or more, I could be yielding 87.9% on cost. And so what this shows here, what I highlight in green, by the way, is the winner. So each row, which basically illustrates a point in time, has a winner. And the winner for the 30 years out, it's Disney. Disney has the highest yield on cost for 30 years out. And again, the reason that they have that is whereas the dividend yield is pretty low right now because they're growing the thing so quickly. And if they can keep that up 30 years out, they're going to have the highest yield on cost. And so basically what I'm saying is if I'm an investor, I don't need the money for 30 years, it's probably better to skew towards stocks like Disney because I can maximize my yield. When I do need that yield, I do need the dividends, I'm getting more. And so that's why I placed Disney, quite frankly, in both of my kids' portfolios. They both own Disney stock because they don't need the money now. They're not paying for vacations now. And so they need it a long, long time, hopefully more than 30 years out. And so because of that, I like to optimize towards those types of stocks for them. That makes the most sense. Now, obviously, I also chose Disney because it's a fun stock for kids. It's something that kids can get excited about. My kids use Disney products and they watch Disney movies all the time. Now, I want to move on to 3M. I love 3M. I talk about 3M all the time. I'm probably going to buy even more here. It's kind of my focus stock right now. I talk about it a lot, but I do want to remind you it's still, as a percentage of my portfolio, quite small. I keep adding, but I don't want to give the illusion here on YouTube that all I care about is 3M. I own 40 stocks. But again, I like 3M now in 2019 because it is on sale. Anyways, 3M has a starting yield of 3.5%. How do I get that? I take the current dividend per share per year. If I take the quarterly one, I add it up 4 times, I get the annual dividend. I take that dividend, I divide by the price per share, which is 163 and change. Current yield, 3.5%. Not a bad starting yield for 3M. It's about as good as I've seen. But again, if I'm going to retire tomorrow, is that the right stock for me? Maybe not. I might be able to do better with Duke or other stocks like that. We'll get to that in a minute. But what's exciting about 3M is it's one of these stocks that has a reasonably okay starting yield, but it's got some growth behind it too. Now, this 11%, I don't know if that's going to hold up over the long term. Maybe it will, maybe it won't. Again, I'm just trying to compare here. But anyways, 5 years out, this 5.76 becomes a 9.71. So they're paying $5.76 a share in dividends per year. Now, presumably, if they grow that 11% per year, 5 years out, it's going to be 971. How do I get that? I'll just do the formula really quick. It's 5.76 multiplied by 1.11 to the power of 5. And so I'll put some of these formulas in the description. Better yet, here's what I'm going to do. I'll put in the description a link to this spreadsheet, and I'll just link to it. I'm not going to have you sign up for my email list or whatnot. I'm just going to link to it. You want to download this Excel spreadsheet, you can do that. It'll give you a little more context behind what's going on here. And the formulas, because I want you all to learn the formulas. The formulas are important. Anyways, I get the 3M dividend. It grows a lot over time. What's fun about 3M is because, again, it's kind of in this sweet spot. It doesn't have the highest growth rate, but it has a reasonably good growth rate and a good starting yield. it basically wins out for 5 years out, 10 years out, and 20 years out. It loses 30 or more years out, and it loses in year one. But for, I would say, the majority of dividend stock portfolios, they're probably going to kind of best be served skewing towards stocks like 3M, in my very humble opinion. At least that's kind of where my mind frame is. And typically it fluctuates over time, but my average current dividend yield in my portfolio, it kind of ranges depending on where the stock market is and what I've kind of optimized at any given time. But it's usually in that 3.5 to 3.8 range. It usually doesn't get above 4. I shouldn't say usually. It'll probably never get above 4 on a current yield basis unless this market just tanks. And usually it will not get below 3. Again, unless the market just skyrockets. There's just some hockey stick. Usually it's in that 3.5 to 3.8% range. And the reason I optimize there is 3M, it's kind of, or in companies like 3M, it's a really good bet for someone who's like kind of like me in my main portfolio. I'm like, hey, I don't want to retire tomorrow, but I also don't want to wait 20 years. I want to kind of do it. I want to have the opportunity to kind of retire sooner than later or start paying bills sooner than later, but I really don't want to wait. I don't want to have to wait too long. And so that's why I like stocks like 3M. And so again, the way I get the yield on cost is I literally take my forecasted dividend and I divide it by the share price, which is 163 and change. And so that's how I get the 3M projected yield on cost in the future. And again, what this is here is a projection. This isn't written in stone. This is just a projection on what might happen. These are some hypothetical scenarios for the future. Now let's look at Duke because it does have its time and place. And so Duke, current dividend is 371. I divide by the share price of 87 and change. Current yield is a 4.3. So Duke, off the bat for year one, let's say, hey, Ian, you need to retire tomorrow. You need to pay bills tomorrow, which is what I want to do with my travel portfolio. It's a 4.3. It's the winner. And so I'll actually tell you here, if I were to build my travel portfolio today, which I'm not, I'm going to wait a few more months here. I'm trying to accumulate a good starting amount. It's certainly going to include stocks like Duke, and it will include Duke. And quite frankly, it'll include some 3M too, because I want a little bit of growth in there. It will not include stocks like Disney. It'll certainly skew more towards the higher yielders, but I will have a little growth in there with a company or two like a 3M. But more often than not, it's going to skew towards the utilities because literally I want the money now. I want to be in Hawaii right now. And so moving on, you'll quickly see even 5 years out with their 3.5% growth rate, yield on cost becomes a 5%. 5.1, and that's lower than 3M, and then it only scales to 12% after 30 years. This is the difference between buying a utility and buying a dividend growth stock. I'd say Duke, it's still growing the dividend, it's still a dividend growth stock, but it's not growing it quickly like a Disney or 3M. And this is the reason why anyone constructing a portfolio that's a little further out, utilities, it may or may not be the right thing. I like to have utilities even though I don't need to access my money right away because it gives me comfort at night. It gets me yield coming in, and it allows me the flexibility that if I want to tap into the dividends tomorrow, we can do that. But I know I'm not going in thinking that I'm going to get some huge yield on it. I know I'm not going to get the huge yield. I know after 30 years, I'm yielding 12% on cost. Now, I think Duke might do a little better than that. So maybe the 3.5, it's a little understated. But that being said, this is the difference between a utility and something else. Now, I'll tell you, psychologically, it's fun to own a few utilities in the portfolio just to get that cash coming in. Because when you're investing for dividends, even if you're not using the cash right now to pay bills, seeing the cash is motivated. And if that can motivate you or me to be better investors, to put more money into the market, to stay more disciplined on the strategy, why not? And so that's kind of how I look at utilities. But I'm not fooling myself. I know when I look further out, if I'm getting all that high yield now, it's not going to serve me as much in the future as going with a high growth dividend stock, a dividend growth stock. When I say growth here, I'm talking about the company growing and I'm talking about the dividend growing. And so you can see though, Duke wins in year one, 3M, year 5, 10, and 20, and then Disney 30 or more. And so really interesting stuff. Now, what does all this mean in real terms? So I'm talking about yield on cost, talking about all these numbers. I know if you're not a math person out there, I hope I haven't lost you. I want to just take it back a step and let you know, what does this mean? Here's what it means. If you or I invest $10,000 right now, I just want to look 30 years out, what am I going to get in terms of dividend income from Disney, 3M, or Duke? Hypothetically, at least, based on this model, and again, the model's not perfect. I'm just making assumptions on the dividend growth rate. Anyways, Disney, $10,000. What do? I just take $10,000 and I multiply by the yield on cost 30 years out, which is 87.9%. I'll be getting $8,790 a year. This is dividend growth investing. This is why it's great. 30 years from now, I don't need to sell my Disney stock. I don't need to sell shares to pay for stuff. No, I could literally just keep all of my shares. Instead of reinvesting the dividend, I start taking the dividend as cash, and 30 years out, it's yielding $8,790, and so per year, and so that's a lot of money. It's almost yielding as much as I put into the thing in this scenario. Taking 3M, it's just slightly lower. It's $8,070. And so I'm only got a delta here of about $700 a year. So 3M, it's looking really strong right now. And it's one of the values out there in the market that I like now. Now Duke, 30 years out, I'd be yielding basically $1,200 a year. So $1,200 is still good money, but on a $10,000 investment, not as exciting is almost yielding my entire investment. And so really cool stuff here. I would love to know what you guys think about this framework. Literally, this is the type of framework that I look at when I'm trying to allocate capital. For most of my investing career, I've been trying to build a portfolio, and I continue to build a portfolio that will pay our living expenses. I'm talking about day-to-day expenses. So I optimize, and I optimize kind of in the middle. I optimize mostly towards 3M type companies, but I've got some Dukes. I've got some Disney type companies in the portfolio, and it kind of mixes together, but it averages out in the middle. With my travel portfolio, I'm going to need the money immediately, so it's going to skew more towards over here, although I'll have some blend from the second column as well. Let's say, like my kids' example, they don't need the money anytime soon, and so hypothetically building their portfolios, they're going to really skew towards this column, but they might have some from this column too. They probably won't have any from this column, and so that's how I think about dividend investing when constructing portfolios based on time horizon in the market. So this is dividend investing for everyone. Hey, I wore this shirt, by the way, for a reason. This is Cross Colors. If you are an OG out there, you're a Thug Life investor like myself, you know what this is. I wore Carl Kanai in another one. Now, what's funny story about Cross Colors is actually Carl Kanai was actually involved in the early days of the company. People ask me, Ian, you want to sit down with dinner with someone, who would you want to sit with, like Warren Buffett? Probably not actually. The person I'd like to sit down dinner with and pick his brain is actually Carl Kanai, the mastermind behind some of this really cool hip hop clothing. And so it's, I talked about this before. You guys know if you're the true OGs out there. But the reason I wear this actually is Cross Colors is basically born out of the hip-hop culture, Thug Life, and basically it's clothing without prejudice. It's clothing for everyone. There's no color lines. It's about no prejudice, and that's what this channel is about. This is dividend investing for everyone. I don't care who you are, if you're a multi-millionaire, or if you're literally just starting out and you're just saving your first $100 to deploy in the stock market. This channel is for everyone. This channel is for all dividend investors. And the reason I love dividend investing so much is it unites everyone. There is, this strategy works just as well for someone who's just starting out as someone that has a ton of money. And really, it is a strategy for everyone, just like Cross Colors. And so, just a fun tidbit from today's video. All right, everyone. Please, if you want to thank me for this video, you want to thank me for the spreadsheet that I'm going to link to, please, the likes, the subscriptions, the comments means the world to me. I check my YouTube stats, and I know a lot of people watching these videos, they have not necessarily subscribed to the channel. And so again, if you love these videos, they help you. If you just take a moment to subscribe, it really would mean the world to me. It's the greatest way you can thank me for sharing this content on YouTube with everyone for free. Hey everyone, I'm so grateful for the community. Again, I just want to thank you all. Really, it means a lot. I've had just a pouring in of positive comments from everyone. Thank you. It motivates me. It really makes me feel good about what I'm doing here, so I really appreciate it. Hey, before I go today, just in terms of full disclosure, I own the stocks mentioned today. Well, actually, Disney I don't own, but my kids do, so both of my kids own Disney stock. And in terms of full disclosure, I am long, personally, 3M, ticker symbol MMM, and Duke, ticker symbol DUK. Own those stocks in my personal stock portfolio. Also, in terms of a disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. Literally just sharing my journey here on YouTube for fun and entertainment. If you're going to go out and invest in the market, please consult a licensed financial advisor first before investing money. Hey everyone, I'm back. Just a quick addendum to today's video. I just stopped filming and I was ready to start editing the video. But before I do that, I wanted to just mention these numbers actually assume that the dividends are not reinvested back into the company that paid the dividend. And so this scenario actually underestimates the value of dividend growth investing. Meaning if you don't need to tap into dividends right away, as time progresses, what you can do is take the dividends and reinvest them into the company that paid them, or pool them and reinvest them into another company that also pays dividends. And the process of doing that can elevate one's dividend snowball even more. It can generate even more dividend income. And so what I just want to say is I always do, I model conservatively. And so this is more of a conservative way of modeling the future. But maybe it is good to model conservatively because maybe some of these growth rates are just a little bit overstated. Maybe the last 5 years on 3M and Duke or 3M and Disney might not be the same over the next 30 years. And so I just wanted to add that food for thought here. That is why I model conservatively. I just want to look at things realistically, and if I can beat what my forecast, I can beat the way I'm modeling it, that's just gravy. And so that's why I do it. But again, I want to point out that this is kind of a simple yield on cost. I am not looking, in this model at least, of dividends being reinvested. And so I'll see you all in the next dividend investing video.